Imagine a tireless genius that never sleeps, never eats, and never panics, yet it's crushing Wall Street's top minds at their own game. In 2025, this isn't science fiction, it's artificial intelligence. And it's picking stocks with laser precision. AI does not chase hype or get swayed by CNBC, just pure data, strategy, and ruthless logic. Some call it the future of investing, others call it a glitch in the system. So is this the smartest investor the world's ever seen, or just a well-coded mirage? Let's find out. The rise of AI in investment strategies. Artificial intelligence isn't just transforming how we search, chat, and drive, it's now shaking up the stock market with the swagger of a Wall Street prodigy. In the high-stakes world of investing, AI has become the new rock star, crunching numbers faster than you can say, portfolio rebalancing. Unlike human analysts who need coffee breaks and occasionally miss red flags, AI algorithms work 24/7, passing billions of data points from earnings reports, tweets, global news, and market signals in real time. The result? A machine with the uncanny ability to spot trends and forecast movements with sniper-like precision. A standout in this AI investing boom is the Dan Ives Wedbush AI Revolution ETF, launched in 2025 like a financial comet streaking across the Wall Street skyline. This fund isn't just any collection of stocks, it's Dan Ives' hand-picked lineup of 30 AI juggernauts, including powerhouses like Nvidia, Tesla, Microsoft, and Palantir. These aren't just tech companies, they are the brains and muscle behind the AI transformation sweeping across industries. Investors are lining up to get a piece of the action, hoping this AI-powered ETF might just be their ticket to above-average returns. With AI calling the shots, investing starts to look less like a gamble and more like a game of calculated advantage. And in an era where data is the new oil, AI is the drill that never sleeps. Performance metrics. When it comes to putting numbers on the board, AI-driven funds are not just playing the game, they are rewriting the rulebook. Take the Alger Concentrated Equity ETF, for example. Under the keen eye of Anker Crawford, this fund has skyrocketed 30% over the past year, steamrolling 96% of its competitors like a Wall Street Terminator. Focused on titans like Nvidia and Microsoft, it's not just investing in companies, it's investing in the AI backbone of tomorrow's economy. Meanwhile, the Kraft AI Enhanced US Large Cap Momentum ETF is no slouch either, beating the S&P 500 by over 10% in 2024 like it was on cheat mode. Even after recalibrating its holdings in 2025, Kraft still clings tightly to its AI aces, including Nvidia and Tesla, the tech world's equivalent of Michael Jordan and LeBron. These are not just lucky guesses or one-off flukes. They're the product of relentless, real-time data analysis and pattern recognition at a level humans simply can't match. Think of these AI funds as financial cyborgs, flawless logic, no emotional baggage, and immune to CNBC-induced panic selling. As traditional fund managers clutch their spreadsheets and stress balls, AI is silently building wealth one predictive algorithm at a time. Investors watching from the sidelines might start wondering, is it time to trust the machine? Because if the numbers don't lie, the robots are already ahead. The technology behind AI stock pickers. Behind the slick returns and market-crushing performance of AI stock pickers lies a powerhouse of technology that's part data wizard, part financial detective. These digital masterminds use machine learning algorithms. Think of them as hyper-intelligent apprentices that never stop studying to sift through mountains of data faster than any human could dream. From balance sheets and quarterly earnings to breaking news headlines, and even the chaotic firehose of social media chatter, AI is listening, learning, and analyzing it all. Platforms like Danelfin and Kavout are at the forefront, offering everyday investors a peek into the future of finance where recommendations come not from gut feelings, but from cold, calculated data. Imagine an AI that spots a subtle trend in Tesla's supply chain chatter on Twitter before it hits Bloomberg. Or one that passes a CEO's tone in an earnings call and instantly flags potential red flags. Yeah, it's that deep. And get this, researchers at the University of Chicago found that large language models like ChatGPT, yes, me, actually outperformed professional analysts in stock picking simulations. Let that sink in. A bot with no MBA, no pinstripe suit, and zero caffeine dependency just beat the pros at their own game. It's not magic, it's math, algorithms, and relentless automation working in tandem. In this brave new financial world, the smartest voice in the room might not be human at all. Challenges and limitations. As dazzling as AI stock pickers may be, even these silicon-powered geniuses have their kryptonite. Sure, they can crunch trillions of data points in seconds, but they are still learning the ancient art of human unpredictability. One big limitation: they are obsessed with the past. AI models rely heavily on historical data to make predictions, which means if a black swan event flaps onto Wall Street, like a pandemic, a sudden war, or Elon Musk tweeting something totally unhinged, they might freeze like a deer in the algorithmic headlights. And let's not forget, AI is only as good as the data it's fed, and that data can carry biases, blind spots, or flat-out noise. If the training set favors tech stocks or overlooks emerging markets, guess what your AI will do? Make lopsided, potentially risky calls. Even worse, AI lacks that all-important human intuition, the gut instinct that sniffs out a sketchy CEO during an earnings call or senses fear in the market before it hits the headlines. Geopolitical tension, market sentiment, a sudden shift in consumer mood. AI might not catch the vibes unless they are buried in numbers. It's like hiring the smartest chess computer to play poker. It'll dominate the data, but fold when it's time to read the room. So while AI might be fast, focused, and eerily good at picking winners, it still needs a savvy human hand to steer it clear of the blind spots only experience can see. The human-AI collaboration. When it comes to navigating the fast-paced jungle of the stock market, the real power move isn't replacing humans with machines, it's teaming them up. Think of it as Wall Street's version of Iron Man. The human analyst brings experience, intuition, and strategy, while AI delivers lightning-fast data crunching, trend spotting, and the memory of an elephant on steroids. Together, they are an unbeatable tag team. While AI tirelessly scans market data, earnings reports, and sentiment trends 24/7, the human mind can zoom out and say, wait, something doesn't feel right here. It's this dance of logic and instinct, of silicon and soul, that's reshaping how investment decisions are made. Instead of wasting hours digging through spreadsheets, analysts now get real-time insights served up on a digital platter, allowing them to focus on big-picture plays and nuanced risks. AI might not get market gut feelings, but paired with a seasoned pro who does, it becomes an incredibly powerful sidekick. It's Sherlock Holmes with a data-obsessed Watson. This collaboration doesn't just improve efficiency, it multiplies the brainpower behind every trade. In the end, it's not about man or machine, it's about man and machine working together to outwit the market. Investor considerations. Is it right for you? So, you are thinking about handing part of your portfolio over to an algorithm. Welcome to the future, but don't forget your seatbelt. AI-driven funds sound good, machine intelligence picking winners, lightning-fast trades, and returns that sometimes smoke the S&P 500, but they're not a one-size-fits-all magic ticket. These funds can be volatile, riding high when tech booms, but potentially wobbling when markets get spooked or when data patterns shift. Before diving in, ask yourself, do I have the risk tolerance to ride the AI roller coaster? Am I chasing returns or building a long-term strategy? AI funds often skew toward high-growth, tech-heavy companies, which means they might not mesh with conservative or income-focused investing goals. It's like adopting a robot race car, fast and thrilling, but not always great for grocery runs. And remember, even the smartest algorithm can't guarantee the future. It's reading the past and guessing the rest. So before jumping in, do your homework, read fund performance reports, and maybe chat with a human advisor who can put things in perspective. AI might run the numbers, but it won't hold your hand in a bear market. Investing smartly means knowing when to follow the machine and when to listen to your own gut. If you found this peek into the future of investing as mind-blowing as we did, smash that like button and share it with your fellow market nerds. Don't forget to subscribe for more deep dives into AI, finance, and the wild world where tech meets money. And hey, ring that bell so your portfolio never misses a beat.